Hi there, welcome to Alternative Investing. I'm Andrew Bell. Here with me, David Kaufman, President of Westcourt Capital. Great to see you again.
Always a pleasure to be here.
This is the show, of course, where we put aside our regular focus on stocks and bonds. We look at some of the other ways you can expand your portfolio and make some money. Today, we're talking about one of the most lucrative and risky ways to turn a profit, buying and selling a small business. Now, we've been talking quite a bit about investing in small businesses through private equity funds and other vehicles. But what should we remember when we're thinking about selling or buying into small companies?
Well, first, how does this fit into alternative investing in the big picture? It is the same idea, which is that people may not think of it this way, but if someone is an entrepreneur and over the last 10 or 20 years they've built a small business into a going concern that's making good profit, they are essentially all in on private equity, that the vast majority of their investable assets are invested in their own business. So from the point of view of succession planning, when they determine what it is that they plan to do with that business as they retire, assuming that their children don't want to take over the business, it's going to be the most important transaction of their financial lives.
So this show should be useful for a lot of our viewers have a business and they're thinking about selling it, they're getting on a bit, they just want to take a break. Or some people may be contemplating buying into a friend or a relative's private company.
Exactly. So if we're focusing on how, for example, a seller might exact the greatest amount when he or she sells their business, by the same token, those people listening who might be interested in buying a small business should understand what it is that they might be able to negotiate into a deal to be able to get the best deal, frankly, for both parties.
Now, the crazy thing here is in the stock market, we see stocks trading 15, 20 times earnings. That doesn't happen in private equity.
No, as we'll see with our guest, David Wasserman, today, in private equity, in general, you're talking about much lower multiples, even the large-scale private equity that we talked about in recent weeks. And in smaller private equity, because it's private and because it's relatively illiquid, you'd expect to get a boost in returns. Yeah. So typically you'd see people that would want to make between 20 and 40% a year, which means that the multiplier, which we'll get into a little later, will be much, much lower. So these 20 and 50 PE ratios, we'll leave that to the public markets.
We're talking about a vast market here, small company private equity.
That's right. Industry Canada says that there are 1 million businesses in Canada with fewer than 100 employees. And I picked up a statistic today that really surprised me, as we see here on the screen, that small businesses with fewer than 50 employees contribute 29% of Canada's GDP, and that 98% have fewer than 100 employees. So small businesses really do drive the economy, but that does not make them easy to sell when the time comes to go in that direction.
Well, coming up, we're going to talk to someone who buys small businesses from people who are about to retire. David Wasserman, Vice President at Lynx Equity, will join us right after the break. Welcome back to Alternative Investing. I'm here with David Kaufman, President of Westcourt Capital, and today we're talking about the ins and outs of selling your small business. Now, a lot of you out there, viewers, we know have small businesses. You're wondering how you're going to get rid of it, how you're going to move on with your life, or some of you may have an opportunity to buy into a small business. Well, there's plenty of pitfalls to watch out for here, lots of opportunities too. We've got David Wasserman on the show. He's a Vice President at Lynx Equity. It's great to see you.
Thank you.
Now, Lynx Equity, typically you buy businesses from the entrepreneur who's retiring.
That's correct. Owners who are looking to sell their business and retire, move on with their life.
Well, tell us a bit about yourself and your career.
Sure. I started in commercial lending with a focus on entrepreneurial businesses, so providing debt capital to owner-managed businesses. From there, I moved on to the advisory side, or what we call the advisory side of the industry, helping those same entrepreneurs either sell their business, raise capital, or ultimately buy a business. And from there, into private equity, which is the buy side for our industry. And since then, I joined Lynx Equity in 2007.
What is this typical small business? Give us a definition of that.
It's very wide-ranging.
Yeah.
For us, it's really a business under $20 million in revenue, between zero and $5 million of what we call EBITDA or profitability, cash flow. That's how we define it, not by employee size. That's going to vary from business to business.
There are many businesses, of course. We just saw before the break how many small businesses there are in Canada, at least by Industry Canada's terms. There are many of these businesses that do make a profit, but some of them, I understand, are much easier to sell than others, or more sellable. So tell us about what kind of businesses are sellable and which kinds are not so sellable.
Well, it's easier to start with what's not sellable. And the short answer is any business where it's 100% dependent on the entrepreneur. He's the fellow who's going out and finding the business. He's the one doing the work. And at the end of the day, he's billing it and collecting the receivable. That's a business, be it a consultant, somebody where they're 100% of it. That's a business that's probably not going to be sellable. But when we talk about goodwill transferability, the ability to have other people do the work, have value created from employees and assets, et cetera, becomes sellable.
What's the number one thing that turns you off when you sit down with the entrepreneur?
Number one thing?
Yeah.
I think the fear that the business is solely dependent on them or their
just
perception.
Dissolve. Yeah.
Exactly. That if they were to get hit by a bus tomorrow, there would be no business.
If you decide that this is a sellable business and that there's something there that's worth buying, let's walk through, I know that we have a few boards to help us with this, how you go about establishing what the fair value is for that business. And let's remember that as the purchaser, you're buying the equity of that business,
Correct.
not the debt of that business.
Correct.
So can you walk us through sort of from step one right until the end, how you go through that calculus?
Sure. For us, given our mandate, the number one most important thing in any business we buy is what we call free cash flow.
Normalized cash flow.
Normalized cash flow,
right,
normalized
okay.
EBITDA. There's a number of different monikers for that. We add back certain items that may be personal expenses that owners of a small business can benefit from. And we're really looking at a 3 to 5 year trend for the business. We're not looking at future performance as an indicator, but more of the past, as well as what are the sustaining capital expenditures that a business needs, and then those normalized or personal items that the business may not have going forward.
Okay, so now you've established this is what the normalized free cash flow is. What's
Right.
the next step in determining what you're actually going to pay for the equity?
We typically assign a multiple, which is the inverse of a rate of return that we expect from that investment. And that ultimately comes out to the enterprise value for the business.
So basically, if you apply a multiple of 10, you're looking to get, you're paying 10 times the profit or 10 times the cash
Correct.
flow. So you're looking to get 1/10 of your investment back each year.
Notionally, it's a 10% annual rate of return. We're looking at substantially higher, but 10% is an easy one.
What is enterprise value, please?
Enterprise value is the value of the equity, so the value of the shares, plus a company's long-term debt. So that's how we look at valuing the business. Every company will have a different capitalization in terms of debt and equity. So enterprise value is a standard.
Yeah, so that's why you subtract the long-term debt from the enterprise value to determine what you're going to pay for the equity.
Right.
And then you'll finance that. You may finance that in a number of different ways at that stage.
Correct. Every business is different. Ideally, in private equity, they like to use as much leverage as possible to generate the returns that the industry is known for. But we're really looking at what is the capital structure that we'll place on the business going forward.
So you get entrepreneurs coming in, and are they disappointed when they hear they're not going to get a 10 or 20 multiple for their business?
It comes down to how their expectations have been set up front, and often it helps us when they have a financial advisor, someone that they've talked to who's realistically set expectations in terms of what they can expect from a transaction.
Once you've determined what you're going to pay for the equity, of course, there are other terms in the transaction that are very important. So
Right.
when you're going to pay them, how you're going to pay
Right.
them, whether they're going to stick around. Tell us about what the seller would expect to have to give up in terms of those issues, other than just collecting the purchase price, of course.
Right. So there's different ways to structure a deal, be it, could be 100% cash at closing. In our industry, very rarely it is. We use what's called a vendor take-back. So the vendor will hold part of the financing.
But let's explain that just a little.
So they'll lend you the money, basically.
Correct,
Yeah.
with repayment terms, and security can vary from the shares of the business to a security interest in the business.
So let's say they have a 50% vendor take back at some predetermined interest rate, of course.
Right.
So they're going to collect interest on their essential loan to you during that
Right.
period of time. And then there is some point in the future when you have to pay them the remainder, of course.
Right. They're acting as the bank.
And then at that point you can replace that debt with what kind of other debt?
Traditional bank financing,
Okay.
or hopefully, for some private equity funds, they've executed their exit from that business at that point in time.
Do you often have a clawback whereby if things don't work out, the profits aren't as good as you expected, you'll get back some of the purchase price?
An earnout is a tricky thing to negotiate, and a lot of people we tend to shy away from it because it is difficult. We prefer the VTB route because we do have the hammer, so to speak, the ability to hold back some of the proceeds if there's a material change in the business. Earnouts get complicated, and they often wind up in court and in litigation, and the only ones who win there are the lawyers.
Now, how long they stick around and what they do if they stick around is important. I mean, remember, we're talking about entrepreneurs here who have built a business, they've run the business,
they love it, they're proud of it.
Right.
Yeah,
so day sale of the business plus one, they come back into work, they still go into the same office if they're sticking around for 6 months or 2 years or whatever it is. From a psychological perspective, how difficult it is for them to recognize, I've handed the reins over and now it's a new world. And what kind of experience do you have in that?
It's split. It's equally split. There's the fellows who it's their baby and they're crying at closing because it's almost like giving up a part of their life. It's their identity. It's who they are. There's other people who it's about the cash and, they're gone the next day and they're happy. We see them both and we've worked with both and we understand kind of how to manage that psychology of the vendor a little bit.
And at some point, whether it's on closing 6 months after, 2 years after, at some point that person will exit the business, of course.
Right.
And I'm interested. These entrepreneurs have typically been able to collect quite significant salaries during that period, which is really they're paying themselves a big part of the profits of the business. Right. So let's say that they were making $500,000 a year and they sold the business for $2 million, net of all the debt. All of a sudden, they have the $2 million in their jeans, but they're not making $500,000 a year anymore. So do you find that there's a lot of examples where, moving forward, the psychology aside, that it's just more difficult for them to maintain the same kind of lifestyle that they might have enjoyed pre-transaction?
Well, I think that comes down to how do you plan before a transaction. And it goes back to succession planning, starting in advance of actually being forced to sell your business, which we talked about earlier. Ideally, they've put aside money, they've planned for their retirement, just like anybody with an RRSP. But for most owners, as you mentioned, this is their single largest asset. There are some benefits when you sell shares in a private company. You can use your lifetime capital gains exemption. So you pay a little less tax on the proceeds. So again, hopefully they manage and plan for this next phase of their life efficiently because, as you mentioned, if they're continuing on with the business, they won't be earning the same income.
Say at a store, a retail business, and a revenue of around $5 million, and let's say EBITDA of around $500,000. What kind of price would you be likely to get for that?
Well, it's going to depend on who's buying it.
Sure.
If I'm your competitor next door and I want to take you out of the industry and I want to close you down and get your customers, I could theoretically pay more than an investment fund like myself who's not in that business, who's just purely looking at an acquisition and a financial rate of return. So it depends on what the buyer's motivations are. Mm-hmm. And again, it's really driven by negotiation as much as we want to put a number down on paper and that's fine.
Can these negotiations really drag on?
They can. Again, there's a lot of planning that in order to execute the business most effectively, start planning 5 years in advance because some owners, it could take 2-3 years to find a buyer. Mm-hmm.
In a lot of cases, the owner will be best positioned to know from a strategic perspective. We just discussed the notion of strategic purchases because you might command a higher purchase price from, for example, a competitor or someone that wants to grow or take you out of the business.
Right.
Can that person, while they're still operating their business and while they still have their eyes open looking around for who the prospective purchasers might be, should they go and knock on the doors of their competitors? Because at one side, they're tipping their hat. On the other side, those are the people most likely to write a check to them in the not-too-distant future. What would you recommend in that regard?
Again, it comes back to, using a financial advisor, somebody who can manage the process. Because as you said, the operator taking their eye off the ball is going to have a detrimental impact to the business. So if you can have a financial advisor who can manage the process, ensure confidentiality is maintained, then you have more of an opportunity to sell to that strategic buyer or that competitor than if you just went and knocked on the door yourself and hoped that they're not just going to steal all of your customer lists.
And are these advisors easy to identify? Is it the same as the financial advisor that they buy their mutual funds with? Is it a different person?
There's certainly a number of people out there. Most accounting firms will have chartered business valuators who can help you understand value and then point you in the direction of an advisor to sell your business.
Right.
David, thanks very much indeed. I bet we'll hear from a lot of our viewers who are entrepreneurs themselves, and we'll return to this topic. Thanks very much.
Great. Thank you.
David Wasserman of Lynx Equity. Well, coming up, we ask you to email us and you deliver. Plenty of excellent questions. David will answer your emails next on Alternative Investing. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital, and we've got a lot of emails over the last few weeks, especially on last week's show on farmland investing. Do you want to walk us through that?
Yeah, I received a lot of emails and phone calls of people, first of all, saying that they had never considered that as an alternative investment, which, of course, part of what this show is about, is introducing people to completely novel ideas, because you're not buying land to develop it, you're buying land that will continue to be farmed. The first question that we had regarded, it was from Robert, regarding how to profit from the rising demand for agricultural products. And the question, as we see here, I loved the show last Friday and want to profit from rising demand for agricultural products. Why wouldn't I just buy commodities futures instead of buying farmland? That's an excellent question. And certainly it is possible to benefit from that. I want to back up and remind the viewers what it is about the macro thesis of farmland that makes Robert ask that question. So the three main drivers are food, feed, and fuel. So it's all based on the idea, it all comes back to, for example, China's middle class. That as China's middle class, which is enormous, grows by 50 or 100 million people a year, that the demand for food will increase. And Western Canada alone is the fourth largest supplier of grain to the world. And if Saskatchewan, with 1 million people, were a country, it itself would be the fourth largest exporter of grain to the world, which is quite an amazing thing. So as China's middle class increases in size and as they demand more protein products, which is exactly what happens in emerging markets, not only will the amount of food they eat increase, the type of food they eat will change. They'll have a demand for more protein, which is much more expensive from the point of view of the inputs to create, and that would drive up commodities prices, hence the question. So you can buy farms, which of course create the products which will go up in value, or you could buy futures in the products themselves. The two issues that Robert should consider regarding what would happen to buy those futures is, number one, futures have to be rolled over. And so I did introduce this as a macro thesis. Yeah. The folks that were on the show last week didn't say whether it would happen in 3 months or 3 years.
It could take years to play out.
It could take years.
Yeah.
And rolling over futures contracts is not something that amateurs should be doing. Now, of course, there are ETFs that we discussed a few weeks ago with the Cash Jane that focus on commodities. But the other thing, and probably much more important from Robert's point of view, is that commodities are much, much more volatile than farmland is. So they may have a low correlation to the stock market and a high correlation to inflation, which is, of course, important because few people think that inflation is not sometime on our horizon. But farmland, over the 50, 100-year time frame that it can be measured, because Stats Canada keeps these measurements for a long time, shows very, very low volatility. So for those investors who would like to benefit in the long term from the increasing demand for the products of the farms, buying the farms, and in the case of the two funds we had on last week, renting the farmland out to the farmers who take the actual risk, would be I won't say that you will have the same returns, but you certainly would suffer from dramatically less volatility.
But, you say renting out to the farmers.
Right.
But, critics of this whole process say a lot of people left Europe because the elite, the rich, owned the farmland, and that's why they came here. They could own their own land. I mean, is this good? You got this prospect of sharecroppers if the farmers get priced out of owning their own land.
Well, let's think about this from the other side of the fence, that if someone does want to take that kind of risk and they believe that the product of these farms, the grains and the corns, will go up in value substantially, why would they want to own the farmland? They'd much rather own the farm and think of it as an operation. Just like a large company that operates in downtown Toronto rents the building that they work in so they can go and do what they do. And so what would happen would be that if a farmer had $3 million to invest into his business, they would have much higher returns, albeit with more volatility, by taking that $3 million and investing it into renting much, much more farmland to produce many more commodities than to buying a single farm or set of acres.
And tying up capital.
And tying it up. And so what you see with the emergence of certainly corporate farming and larger farms, which are much more efficient, of course, that you'll see less of an insistence on the ownership and a much bigger focus on the renting.
Let's move on. We got an email from Laura. I agree with the investment premise regarding farmland from your show last week, but I want to know, can I get paid to wait? for the increase in value the way I would with dividends on stocks or interest payments from REITs?
That's a great question, Laura. One of the first things that one has to establish when they're talking about investing in farmland is sort of what bucket it fits in. Is it real estate? Is it private equity? And the answer is it's a bit of both. Now, we certainly have been programmed in this country in recent years that if you invest in real estate, that you should get paid to wait. There should be distributions along the way. But one thing that people often forget is that in a REIT, there is always significant leverage. It might be 60 to 65% leverage.
Because they use debt.
They use debt to buy, for example, an apartment building or an office building that they're going to rent out. So the reason that they're able to pay out 7 or 8% a year to their unit holders is largely due to the fact that they use that leverage. Now, you can use that leverage in farmland, and certainly you would be able to get paid to wait, to use Laura's term, where you would, the distributions, i.e. the rents that you collect, or if you want to farm it yourself, the proceeds from the farming would be substantially increased because, of course, of the use of leverage. However, what the fund managers we had on last week were advocating was looking at this as a leverage-free proposition, because if someone's looking for preservation of capital, leverage, as we know, is often your enemy. And so those are the two things that would fight against each other. If you want to get paid more now, you need to take a little more risk through leverage. If you don't need to get paid now, don't take the leverage and let the capital appreciation be the main source of your returns over time.
Yeah, it's fascinating stuff. I'll blog about this or Twitter about it, because the National Farmers Union is they're anti what they call factory farming, and they have some concerns about this, outside investors buying up farmland. And it's going to be interesting. There is some political risk with this thing.
Well, there's certainly political risk. One of the things that I come across when I do my research on farmland is that part of what happens as you have the accumulation of larger farms is the automation and technological efficiencies, which in the end, of course, can drive people out of jobs. And so that's a different idea, of course, than what the most efficient way is to run a farm.
What have we got coming up next week, Tim?
Next week is going to be a very fun show. We're going to talk about high-frequency futures and options trading. And our guest will be Dino Verbruge from DV Trading. And this is sort of what people think about when they think about traders, having 20 or 30 people in a dark room, 4 or 5 screens in front of them, trading in real time, using options and futures to make bets in different directions.
Basically on equities?
They may be on equities, but it could be financial futures, it could be commodities futures. And the point is that, and I think what we'll hear from Dino, who's going to be a fascinating guest, is that the pros don't so much make these big bets, these directional bets, as they try and discover relative value. They try to discover either temporarily or permanently mispriced options and futures and try and benefit from that without taking a macro risk or making a directional call.
Good stuff. We will be back next Wednesday with another edition of Alternative Investing. Get your emails into us. We want to hear topic ideas. Alternativeinvesting@bnn.ca. Thanks for watching. Have a great weekend, everybody.